today on Ag News Daily.
It's not good. It's not the way it should be. I mean, you shouldn't have to work your entire life and hit one bad cycle that you did nothing wrong in, just your regular operation, and lose everything in a year. It doesn't make a lot of sense, and it shouldn't be that way.
Welcome back to the weekly edition of the Ag News Daily Show. Do we need to reintroduce ourselves?
You sure can, Tanner.
I'm Tanner. She's Delaney.
It's kind of fair week for you.
It is. What a cluster of a week, but I think it's that way for most. Here in the Midwest, though, weather-wise, we saw showers and thunderstorms. They've seemed to be a frequent occurrence and will continue into the weekend as well as next week. Temperatures, though, should stay mild through the weekend, but will climb into the middle of next week. Late summer heat stress could cause growing conditions to turn away from the favorable conditions we have had here throughout the Midwest in July, but we'll wait and see there. In the southern and central plains, rainfall has recently supported corn and soybean growth there. A passing front should bring more showers and storms over the next few days. While temperatures are seasonably low, they will rise into the weekend and into next week, bringing some drier conditions with them. Now, when we look into the northern plains over the past week, heavy rainfall and some severe weather took place. More storms are expected to be headed that direction into the weekend and through the first part of next week as this active pattern continues. Temperatures will remain near normal, while some areas may miss out on rain, and overall conditions will still remain favorable for crop development. I've been seeing a lot of Snapchats saying, well, we got our daily rain or our weekly rain. Seems to be quite the weather pattern this year.
It has, and it's leaving a question mark for whether or not we'll see a summer growing season rally as we head into the final stretch of the season here. According to USDA's latest crop conditions report, mostly favorable conditions again last week, as 74% of the corn crop was rated good to excellent. About 34% of the crop has silked and 7% reaching the dough stage. Soybeans were rated 70% good to excellent, up from 4% from the previous week. Nearly 37% were bloomed and 15% had started setting pods. On the wheat side, winter wheat harvest was 63% complete, just behind the average pace. Spring wheat was rated 54% good to excellent, up from 4% the week prior, with 78% of that crop now headed.
Plenty of headlines around the tariff news. Lots of headlines here are circling that trade front. To kick the week off, let's start with the newest trade deal announcement that came this week between the U.S. and Indonesia. The agreement calls for U.S. imposing a 19% tariff on Indonesian exports and reducing that from the 32% that was imposed on the country in April. After first announcing this agreement on Truth Social, President Trump told reporters that Indonesia would not charge any tariffs on American exports. He also said Indonesia is committed to buying $15 billion in U.S. energy, $4.5 billion in American agriculture products, and 50 Boeing jets, many of them being 777s. Nearly 24 hours after President Trump made this announcement, the Indonesian government confirmed the details on their side as well. So another momentous trade deal for the U.S. administration and a win for agriculture to be called out specifically. Other headlines, President Trump is proposing new tariffs on Russia and stepping up the pressure on U.S. trading partners around the world. He announced earlier this week that the U.S. would impose a 100% tariff on Russia if it does not halt its war on Ukraine within the next 50 days. He described the move as an ultimatum to force a ceasefire. Now, the proposed tariffs wouldn't just target Russia. President Trump said they would apply to secondary tariffs aimed at countries continuing to do business with Moscow. That would include the trade of energy, ag products, and weapons. More than a dozen nations across Asia and the Middle East and South America would be affected. There's also quite a bit of speculation on a deal that might soon be imminent with China. The U.S. Secretary of Treasury, Scott Bessent, stated that in a media interview on Tuesday that we shouldn't worry about the August 12th deadline, which would end the tariff cooling period with China, raising some speculation that each side has had enough leverage to force another deal.
Certainly a lot of trade headlines this week, Tanner, because last weekend President Trump also announced a separate 30% tariff on goods from the European Union and Mexico set to take effect on August 1st. The EU responded by delaying retaliatory action and said it would continue with negotiations. In letters posted online, he warned both the EU and Mexico about the upcoming tariffs. Similar letters were sent to 23 other countries, including, of course, Canada, Japan, and Brazil, major U.S. trade trading partners. Those letters outlining possible tariffs ranging from 20 to 50%, copper alone facing a 50% tariff rate. China, President Trump said, facing new tariffs on August 1st. Products covered not by the USMCA will face a 35% tariff. Potash alone will face a higher tariff rate of 10%. President Trump also voiced concerns over Canada's tariffs on U.S. dairy products, saying they restrict American access to the Canadian market. This issue has also been raised by other countries, including New Zealand, and is part of ongoing trade discussions under the USMCA and the Comprehensive and Progressive Agreement for the Trans-Pacific Partnership. Really a lot of headlines there to get through with trade, but it seems like things are moving and shaking here under this administration.
That's right. And it looks like you've got more headlines.
I do. One more final headline here. I guess it's kind of a trade-related one here, but on Monday, the U.S. Commerce Department announced it is ending the 2019 agreement that paused the anti-dumping investigation into tomatoes from Mexico. The original tomato suspension agreement, established in 1996, was a deal between the U.S. and Mexico. Under this agreement, Mexican tomato producers agreed to sell fresh tomatoes in the U.S. at set reference prices. In return, the U.S. agreed to halt its anti-dumping investigation concerning those imports. With the agreement now terminated, Commerce is now issuing an anti-dumping duty order, placing a 17% tariff on most Mexican tomato imports. These duties are designed to address unfair pricing where tomatoes are sold in the U.S. below fair market value. Commerce Secretary Howard Lutnick said, quote, "Mexico remains one of our greatest allies, but for far too long, farmers have been hurt by unfair trade practices that are undercutting pricing on produce like tomatoes." That ends today. The department's enforcement and compliance unit will enforce the new duties. Currently, Commerce maintains 768 anti-dumping and countervailing duty orders to protect American companies and workers from unfair trade.
As long as they leave avocados alone?
I guess as long as they leave avocados alone, we can continue having that guacamole.
That's right. Well, we saw more U.S. farms file for bankruptcy in the first 3 months of 2025 than all of 2024. That's now according to research coming from the University of Arkansas Extension economist Ryan Loy. According to that report, there are 259 bankruptcy filings in early 2025, the highest number, unfortunately, since 2021. They said that, quote, "We've already beaten last year in terms of national filings just in the first 3 months of the year. Once you see this on a national level, it's a clear sign that financial pressures that we saw before in 2018 and 19 are now reemerging. A large part of the pressure comes from the commodity prices being back to where they were in the 2018 and 19 era. Adding this pressure is a consistently high cost for seed, fertilizer, pest management, and diesel fuel." Scott Stiles, an instructor with the Extension economist at Arkansas State University, says the issue extends beyond the farm gate and could have ripple effects across most of rural communities in the broader ag economy sector. Stiles said in his quote that there's downstream impact on other segments of the ag industry. Your input suppliers, your equipment dealers, anybody who provides the service to a farmer could be impacted by this as well. So not great news in that headline.
No, certainly not. Definitely seeing that pinch at the farm gate level, I think, across many farm sectors, Tanner. On July 9th, the Department of Justice filed a lawsuit against the state of California. Governor Gavin Newsom, Attorney General Rob Bonta, and other state officials arguing that California's egg laws go beyond state borders by forcing out-of-state producers to follow its rules. Additionally, the lawsuit argues that state laws conflict with the Federal Egg Products Inspection Act. It also claims that Proposition 12's cage-free standards break the Supremacy Clause. The plaintiffs in this lawsuit say that in the 2 years after the laws started, egg prices went up by about 20% in the state, more than they would have without the rules. Ag Secretary Rollins said, quote, "It is one thing if California passes laws that affect its own state. It is another when those laws affect the states in violation of the U.S. Constitution." The American Egg Board told Brownfield that farmers have been responsible in meeting the demands for cage-free eggs while supporting all types of production. They say that while They will keep following California's laws and watch this lawsuit closely to see how it unfolds. So another Proposition 12 piece there. We'll see how that works out for poultry producers.
That's right. Secretary Rollins remains busy. The U.S. Secretary of Ag has announced on Tuesday of this week a new plan to boost food safety at the USDA's modernized Midwest Food Safety Laboratory in Normandy, Missouri. This plan now includes increasing Listeria bacteria testing, training inspectors with new tools, and weekly data collection to spot food safety risks early. Now, when we look at developing a salmonella strategy, replacing the previous plan after concerns about its impact now on small producers. We're also seeing increased enforcement with a 36% rise in actions to address repeated violators and ensure compliance throughout the industry. The Food Safety and Inspection Service will also be provided $14 million to support state meat and poultry inspection programs as well. 29 different states currently run these programs under cooperative agreements with FSIS. This year, the USDA plans to update those agreements to improve oversight, training, and coordination. So we'll continue to keep an eye on there as well.
Tanner, July is National Ice Cream Month. I didn't even know, and I haven't had any ice cream yet to celebrate.
Well, that's your own problem, but what a perfect month.
What a perfect month to celebrate, and a great segue into this next story, as many ice cream makers are pledging to remove artificial coloring from their ice cream products by the end of 2027. The International Dairy Foods Association announced the voluntary move on Monday, which includes red dye 3, red dye 40, green dye 30, blue dye 40, yellow dye 5, and yellow dye 6. This pledge covers ice cream and frozen dairy desserts sold at grocery stores and other food retailers, but does not apply to non-dairy items or small batch ice cream made in-house. Secretary Rollins praised the effort, calling it a step toward better health for American families. Other major brands, including Nestle, Kraft, Heinz, and General Mills, have made similar commitments. Health Secretary Robert Kennedy Jr. says about 35% of the food industry has now pledged to eliminate chemical dyes, and FDA Commissioner Marty Makary said that 4 new natural colorings have been approved this year, including gardenia blue, to replace some of those artificial dyes. The announcement follows a separate pledge to remove artificial dyes from school foods by fall of 2026, and earlier this year, the dairy industry also agreed to lower added sugars in flavored milk served in schools. Tanner, do you have a strong opinion about that since you have kids in school right now?
I don't. I probably should, but I really don't at this time. I think it's a positive move as far as that goes. American biofuel producers are on track to use more than half of all U.S. soybean oil next year. Agriculture.com reports that a wave of federal policy changes are transforming biofuel sector, which includes higher blending mandates under the Renewable Fuel Standard and new limits now on renewable fuels and feedstocks from overseas. In the latest supply and demand report, the USDA sharply increased its forecast for soybean oil used in biofuel production, raising it to a record 15 billion pounds for the 25-26 marketing year. That is up more than 11% from last month and marks the highest ever projected use. At the same time, the U.S. soybean oil exports are expected to drop to just 700 million pounds, down from 2.6 billion pounds this season. This comes as more oil is going to be consumed domestically. The EPA is also proposing to reduce the number of renewable identification numbers generated for imported biofuels and for fuels that are made from foreign feedstocks starting in 26. This move is expected to further shift demand towards U.S.-grown soybeans and domestically produced renewable fuels. So it seems like a positive move there for ag and for those that are growing soybeans.
It certainly does, and should be a positive, maybe long-term for the markets. But here's an interesting vertical beef market for Nebraska and Western Iowa producers. We're chatting today with a very interesting market development, so let's get into that interview now.
Well, listeners, I'm excited to share a guest with you that I've got to have conversations with on Farm for Profit before. So Chad Tentinger here, he's here with Legacy Beef Co-op, wears a lot of different hats because he's also in various roles, but I'll let him tell that story. So welcome to the podcast. Thanks for having me again. It's good to be here. Let's start off with that background. Let the listeners know everything that you're tied to in the beef industry. So right now, it's really 3 companies. We have 10 Corp, which has always been around, I guess. That's been my career. It's been around for about 20 years now. That builds cattle buildings, cattle facilities. It it's a general construction firm, but to be honest, it's a cattle company at this point in time. We focus on cattle. We still do shops and everything, but it's all egg tied. So then, a few years back, we started on Cattlemen's Heritage Beef Company. That is the building of a packing plant outside of Council Bluffs. And as of today, we own the land. We're fully permitted. We cleared the land. We just got annexed into Council Bluffs, which is great. It opens another door into funding. So all that's moving forward. At the moment, we're just holding tight until the market turns and indicates that we should build the plant at the right time. And in the meantime, we have started Legacy Beef Co-op, which will be the cattle supply to Cattlemen's Heritage. But at the same time, the co-op is its own entity. It stands on its own feet, and it is designed to bring producers together to help each other where we can. And primarily we can help each other is marketing and buying power. So it'll be coupled to 500,000 head of cattle together. And it's exciting. We're just launching that, and we're going out with an equity offering. We've started talking to producers right now with that equity offering, and we will continue to be for the rest of the year.
What a super interesting and unique vertically integrated plan that you've put together here to have the vision to do this, I think is interesting and unique to the marketplace. Chad, I'm curious to know, what was your background to be able to have the vision to pull this idea together?
Well, I've been a cattle feeder my entire life, grew up on a cattle farm. My grandparents, my parents, my brother, myself, we've been feeding cattle on the original family farm in Remsen, Iowa since the late 1800s. So grew up in the industry, been around it my whole life. At a certain point in time, the markets used to behave like you would expect markets to. The Board of Trade helped. You could hedge. There was tools that helped us along. And every so often there'd be a big disruption. What we noticed starting about a decade ago is there's a direct disruption every year. Something new. The markets get detached from the reality on the ground, and now you lose tools to hedge, you lose tools to protect. And as we looked at that, it just kind of came to us to say, hey, we got to just kind of level this playing field. We got to work together. We started looking at the large feeding operations in the South, and obviously numbers matter. Now, we have no desire to have a 500,000 head feedlot in Iowa, but we can get the same protections that gives us by just working together as individuals, run our own individual farms, market our individual cattle, but at the same time having better markets to market into and having more stable markets. It's really designed to make sure everybody's independent, but can work together to get the same advantages of these large feedlots. So that's how it came to be. I just started looking at this, working with family farms every day. The young farmers, right? I mean, they don't have the desire to ride the roller coaster like some of the older generation did, right? When I was growing up, I was told, when cattle are good, go buy an 80. When it goes down, hang on for dear life. That's not the best business model, and It gets real hard, and it's not good. It's not the way it should be. I mean, you shouldn't have to work your entire life and hit one bad cycle that you did nothing wrong in, just your regular operation, and lose everything in a year. It doesn't make a lot of sense, and it shouldn't be that way.
So what's the response been from producers as you've been going around having conversations, trying to continue to move this plan forward?
So with the co-op, the conversation's been amazing, right? Everybody gets it. We're in a great part of the cycle, right? If you're a cattle feeder today, I don't think you have much to complain about. Maybe replacement costs, you could complain, but who's going to listen to that, right? But right now it's great. So the response has been, when we just really talk about coming together, biggest thing everybody wants to be is independent. You are staying independent. You're just joining a co-op to work together for better marketing, better buying power, and level the playing field. One of the things that we have incorporated into the co-op pricing structure is a floor. The floor will be tied as a percentage to the box beef cutout. We don't have the exact floor negotiated yet. We're always actively negotiating, but just to give you an example, if at 85% was a floor, think about the history in the last 10 years, how many times that'd be helpful. I don't think anybody looks backwards at COVID, whether you're a producer or a packer, and says, you know what, that was handled perfect. Because if you really think about what's going on today in the cattle herd, it's a direct result of cow-calf guys getting out of it, cattlemen getting out of it, because in COVID, we just lost too much money. So in hindsight, it would have made a lot more sense to say, well, we're going to put a floor under that. Everybody's going to make some money through this. And maybe we still lost money, but not as much money. And at the same time, guys would have stayed in the business. And then moving forward, the packers wouldn't be losing the money they're losing today.
So, Chad, let's talk a little bit more about the legacy co-op model. So you just started collecting, or signups just opened as of July 1st. Legacy Beef Co-op is going to be an owner of the packing facility, which hasn't started yet.
Correct.
Kind of punting that until we see markets stabilize.
That's right.
Walk us through how that system is going to work for producers. How can they buy in? What are those shares going to look like? What's that system going to look like?
So right now what we've done is we are obviously coupling cattle together as we speak. Right now it's $62.50 a share. One share represents one delivery obligation, one head. We are working with packers in the industry today, existing packers today. We've added another step, like I like to say. Everything we've talked about in the last 2 years is still in play 100%. That's moving forward. We've actually added another step to say, well, in the meantime, let's start making money together. So we're going to deliver into the existing system. What we're going to have is a better grid, a negotiated grid, which, negotiate it for our cattle, right? So premiums, discounts, but more premiums, a better grid to deliver on that'll be more profitable, a grid that you can't get by yourself, that will have guardrails. Guardrails are the floor we talked about to guarantee that it's kind of a built-in put, but when the CME detaches from the boxes, that's our protection. So for the $62.50, you have one delivery obligation. We'll be able to start delivering cattle starting the 1st of next year. So if you think about it, we, at best case scenario, we break ground next year on the plant because market indicates it. Great. Still a 2-year build. For the $62.50, we'll have more than likely have our investment back before we even start delivering into a new facility. Now's the time to come together to make sure that we can do all these things together. And, the co-ops have always been the most important part of this, right? To build a plant is one thing, but if the producers don't own it, you gain nothing. If private equity owns a plant, private equity gets paid.
Yeah. I love, and we don't do this very often on Ag News Daily, but there's been great conversations we've had with you on Farm for Profit that really go into grave detail as to how the process was come about, what your goals were. And I'm excited to hear that there's pivots in there to continue to help producers. I want to know, in your opinion, is this the future of beef? Where do you see the future of beef production going?
I personally think if you look around the country right now, you see large feedlots in the South. You also see some of the large in the Texas Panhandle, fighting for water now, fighting for feedstuffs. I think we'll see a shift to the north more, certainly tying 10 Corp back into it, but with modern cattle facilities, it you get rid of the mud, you get rid of the weather. It's a lot easier to feed cattle profitably in the Midwest. But you're seeing more and more groups come together. This is our group that we're putting together, but I think standing on your own as a family farm, 500 head, 1,000 head of cattle is going to be harder and harder in the future to make sure that you get a fair playing field. So I don't see any reason why we wouldn't come together to make sure that we level that field. If you look in the past, I think U.S. Premium did this in the late 90s. It's not a new concept. They got together down there to make sure in Kansas that it worked for them. It worked extremely well. It's still working extremely well. I think the future of the cattle industry is, there's going to get to be fewer and fewer feeders, especially if we don't work together to make sure we can stay here. Because you can't negotiate 500 head of cattle. You can't negotiate any kind of a selling deal. It's difficult.
And I'm also curious to know, too, what's the response been like when you think about the future of the industry? We talk about consolidation, especially in the hog industry. I think a lot of producers are trying to see that be prevented in the cattle industry. Packer response to this, what has that conversation been like?
Well, I think the big thing that when you talk to cattle producers, we're all fiercely independent, right? And you'll hear that all the time. We don't want to be exactly like the hog business. And I say, well, that's fair. But there's a lot in the hog business that we should be looking at that saved a lot of family farms, right? Modernizing your facilities, was a great thing for the hog industry. Owning cattle or hog barns at that time frame kept a lot of people on the farm. The cattle industry should take some of that into account and say, by modernizing, feeding cattle, working together, it's been a great response. The biggest thing that cattle feeders want, they want to be independent. They don't want to be tied to a complete system of how you sell your cattle, which none of this is. How co-op is put together, you're still going to trade your cattle like you would any other time. You're independent. The difference is you just have a better grid when you negotiate your base price, right? I mean, when you're selling on a grid, all you're doing is negotiating your base price. I will also say the cattle industry, what I've seen over the last decade for sure is everybody says, I like to trade cattle. Every cattle feeder, I want to be trading cattle, so I don't want to be in a system. Well, the reality is you trade cattle the day you buy them, right? You've out-traded. You're sitting in a sale barn. You're sitting on a ranch. That's where you've done your trading. When we go to sell cattle today, there's no negotiation as far as a live price. If the price is, I'll just use current model like $235, for example. If you get $237 in the afternoon, you didn't negotiate to $237. Everybody rose at the same time because they couldn't get cattle bought.
Yep.
You know, in the exact same moment, you're not going to be on your farm and I'm going to be on my farm and I'm going to get a buck more. It just doesn't happen anymore. So you're really not trading at the end. The best way to trade at the end is make sure you have a grid that works for you, or even on a live price, you'll still be able to sell live, but, you know, put some floors in here to make sure that you don't get your head taken off. You know, during COVID, you're talking about $500 swings on cattle. This would have been a great tool to have.
Yeah, you're exactly right. And I know that we're going to catch the attention of some producers today when this goes live. So if they want to reach out to you, want to dive in deeper themselves, how best do they connect?
LegacyBeef.com is the best way. Just, you know, we're all over. Google it. It's on Facebook. It's everywhere. Reach out to us. You know, when I say there's not a cattle feeder that's going to hear this that should be part of this, I'm serious. If you're in the cattle business, take a serious look at this, because this isn't a program for one or two people to, you know, collect a bunch of fees and make a lot of money, right? It's not set up that way. This is a co-op. When you're a member, you're a member. So if the co-op makes money and there's excess money, it goes back to its members, right? This is set up truly, for me, it's a passion. Right. I've been doing it for a few years now. Right. I have my other companies that are important to me, but the co-op is important to me because somewhere down the road, we as an industry have to decide, do we want to look like other parts of the country where there's just a handful of standing, or do we want to look more like it is today, where independent farmers are still independent, working together? We still have our small towns and it's a community. We as an industry have to make that decision sooner than later.
Yeah, absolutely. Well, I appreciate you coming in the studio again. It's always great to see you, and for sharing with the Ag News Daily audience what you got going on.
Yeah, thank you guys.
It's always great to talk to Chad. Appreciate him stopping by the studio. But in fertilizer, last week's update from Josh Linville of StoneX showed India's urea tender aims for 2 million tons, with 1 million secured. Strong monsoons and low prices have signaled high demand, and another tender possibly coming soon. China raised its 25 urea export quota to 3 million tons, offering some relief despite being below normal levels. North American urea prices are rising with global markets, but remain at typical discounts. Tariffs are not a major factor, and the import demand right now is low. No UAN summer fill programs have been announced, but supply is tight. Manufacturers are controlling the pricing. NH3 programs have solid interest. Expected corn acres of 93 million point towards strong fall demand in that category. Phosphate exports from China remain light, while Indian demand was strong due to good monsoons and low prices. As mentioned, overall global supplies are tight as key export limit their shipments through tariffs. U.S. phosphate production is low. Prices are expected to stay high even if tariffs are lifted. Meanwhile, the DAP to corn ratio hit a record, surpassing the 2008 levels we've previously discussed. Lower grain prices are providing little relief to farmers as they look long-term. There are some phosphate projects underway in Egypt, Morocco, and Norway. So we'll look at those. In potash, the summer fill programs are seeing strong demand as farmers prepare for the season. However, prices are higher than they were last year, which is disappointing many growers. The potash to corn ratio also remains high, combined with those rising phosphate costs and low corn prices. Farmers may reduce that use of potash this fall. Some experts will see this as a tipping point where high prices could change buying patterns, but we'll have to wait and see.
Well, Tanner, taking a look at the markets this week following last week's WASDE report, which was released on Friday after our show dropped, grains have been on the move. The biggest surprise from last week's report came on the corn data side from global numbers specifically, as USDA cut its 25-26 ending stocks estimate to 272 million metric tons, well below the 277 estimate. After touching 407 in new crop corn early in the week, December corn has now flirted with 425 this week, putting on a bit of a bump following last week's report. The report trimmed U.S. soybean crops to 4.3 billion bushels, a slight cut from last month, added 50 million bushels of crush demand this month, but trimmed exports by 70 million bushels from elevated domestic usage. So all in all, kind of canceling things out. November soybeans successfully tested the psychological support level at $10 to start the trading week, but clawed their way back to double-digit gains on Wednesday, putting 18 cents on the board in the new crop contract. August weather models continue to suggest risk in the Midwest, the critical month for soybeans. So we will see if we get a late season summer rally here, but continuing to see pockets of rain throughout key parts of the growing season, Tanner. So we will see how that shapes up.
That's right. Well, I think I know where I'm headed next, listeners. Maybe you'll be doing the same, but I'm pretty sure I'm getting a scoop of ice cream.
And heading to the county fair.
That's right. And maybe both of those happen at the same time. Who knows? It feels like weeks like these all run and disappear very quickly, just like the summer. So if listeners, you've got people we should talk to this summer, make sure you send them our way. Continue to connect with us on social media. We always appreciate you and those interactions there. But for today, what do you say? Should we let them go?
Let's let them go.